episode of Frank Perspectives. Data is the new oil, and banks, by that logic, will be the large oil wells. Now, with the amount of data which is generated in banking industry, it is natural that with the tools which are available now, they would want to leverage this and build models that can help reduce process time, reduce manpower costs. But COVID has changed the way data looks like today, in some areas fundamentally. Therefore, these oil pipelines may need to be relayed. And to discuss how the data and analytics landscape is going to change, going to transform, I have with me a seasoned advanced analytics professional, Roopam, who has more than 18 years of experience in machine learning, statistical modeling, data science, predictive analytics, and business consulting. He has successfully designed, developed, and deployed advanced analytics systems with organizations such as IFC, which is a World Bank Group entity, American Express, Reliance Capital, Axis Bank, Allstate Insurance, DHFL, Wipro, Syntel, etc. He has also helped and mentored analytics professionals from various organizations, including ICICI Bank, Crompton Greaves, University of Central Florida, Hapag Lloyd. He's a popular blogger in the area of data analytics, and you can read Roopam's predictive analytics and big data blog at ucanalytics.com. He's an IIT Bombay alumnus and now lives in Mumbai. So very warm welcome to you, Roopam, and thank you so much for joining in. We have been discussing this for a long period of time, and finally you could take the time out to discuss the changing landscape of data for the banks today.
Thank you so much. Thanks for inviting me, Amit. I think Frank Bunker is doing a phenomenal job, and congratulations to you for that.
Thanks, Roopam. So I'll get straight away to the questions. And one of the first things that is coming to my mind, which I said in my introduction also, is the way the data is coming in, based on which, as a bank, I had made some models. That data, the shape of the data, may possibly change with the impact of COVID. So the variables which were part of my scoring models, which were part of my automatic credit decisioning models, those variables, are they going to change fundamentally?
No, that's a very good question. And there's a lot of, the jury is out there. This is one thing which is being deliberated a lot. And overall, if you see, it's not so much of a variable problem, but the information that was coming through that variable. So I'll give you a few examples just to illustrate my point. If you see, typical credit scoring model are based on fundamentally 12 to 15 odd variables they have in them. And these variables broadly can be classified as demographic variables of what kind of person or the entity that you are giving loan to is. So demographic variable, then there are financial variables. Financial variables where about their income, about how their expenditure is, disposable income. Third side of the variables is the repayment track record, where you're trying to see, okay, if somebody is paying their historic EMIs and installments on time or not. So if you see, fundamentally, these variables are very strong. And that's the reason why the traditional credit scoring model have a lot of weightage to them. And these weightages are defined using statistical analysis and deeper mathematics. So in terms of variables, the variables are not going to change. Now think about what COVID is going to make a difference. Let me take up the one which we all know is going to change, is the repayment track record. And why it is going to change is because the government is intervening or trying to help out people by applying either moratorium or forbearance, where banks cannot share the information about repayment track record of the borrower in the last few months. So primarily what has happened because of this, something like repayment track record was important. But if I am going to underwrite a loan, let's say 3 months down the line, I will not have a whole trail of repayment track record. And as soon as the moratorium is gone, people will start making payments, a new set of information will emerge. Similarly, if you look at financials, we know we are going through a very tough time in terms of economy as a whole. And because of that, the kind of information that you have about somebody's financials 6 months ago will not hold true today, and we don't even have that information readily available as such. So how things are changing in terms of somebody's financial, whether it's an entity or whether it's an individual, it holds true for everything. So that's where I see it's more of a gap in information rather than change in variable completely.
But there are few things which come to my mind, Rupam, based on what you've said. One is, of course, the repayment track record and our ability to see the repayment track record. And of course, there is some disruption there. To fill that gap, you may possibly need to rely more on the other variables of how the business has been run, what is the integrity, and look at some softer aspect of evaluation. Now, the moment you start bringing the softer aspects of evaluation, because your quant is weak or has a disruption, right, may take time to build up again. Are you moving it from, making your systems fully automated based on credit scores to again towards judgmental kind of models wherein a credit officer's own evaluation and assessment and experience will come into play, especially more in the large ticket lending. So we were slowly moving in from retail and cards and those kind of smaller ticket lending to implementing the scoring based model for slightly larger ticket lending. Does it take us one step back?
If you see even historic models, the way they were built, judgment played an important role. So your understanding of business, your understanding of banking played an important role in the way credit scoring models were built. So though it's a data driven, but data was essentially validating the hypothesis or business assumptions. And once those assumptions were validated using data, that's when those variables were going in the scorecard. Whether the judgment or the experts will become more important, they were always important, to be honest. In current times, when these models are, I won't say not behave properly, but the information that will go in them will not be as similar to what they have seen before. And that's where one assume that there are going to be some level of variance or not such a stable results from these models. At this point, again, like the question will be, who is an expert? And when we answer this question, experts are expensive. So that's the reason why models put in pick.
That's the whole reason of automating the decisioning in the credit. An important question is, are banks ready for it? Do they need to do something very different to build their ability to look at these variants that you're talking about, correct, in the data? Have banks prepared themselves, or they have been carried away with the technologies which are available or the rating modules which are available? Most of the rating modules which the banks use today are primarily from the credit rating agencies, right? Right from there. So have banks approached historically, and it's not a very long history, but historically, have the banks approached it in the way that prepares them to handle the situation right now? Or do you see some lacuna or some gap there?
So there are gaps for sure, because when we talk about banking as a system, like within India, you have got so many different banks. There are private sector banks, they are slightly more advanced. There are public sector banks, and then there are corporate banks, and like you can keep going down. What I foresee is something that probably not just banks, but organizations were possibly postponing the whole aspect of digitalization, the whole aspect of using that data, because digitalization has no meaning unless you do data analysis, because that's where the competitive advantage is coming. So everything that they were postponing is now staring in their face. And having said that, like I think whatever things are going to be speeding up. So now we are all working from home. Like, I mean, we can all see each other's houses at this point. And that's the scenario with every employee across India. And that will bring in the aspect of digitalization and the associated data with it.
What about the technical capabilities within banks?
So technical capabilities can be divided into small blocks. One block is whether they have data. So first thing to make a start cooking is whether you have the ingredients. I think most banks do have good data, and data that is at least internally collected. So they are managing their systems like they may not be as advanced as LOS and LMSs, but there are certain systems and processes are placed in most banks that you can think of.
Correct. At least the core banking aspect for every bank is digital, and therefore you have that itself is a very large data pool to work on.
To work with. And so data is there. The quality of data could be a challenge, and that's always the case. Whenever you start analytics, whether it's a small bank or a big bank, if nobody has analyzed that data, it always starts with a process of cleaning that data, putting it in order where it is kind of speaking to you rather than just telling you jumbling words and giving you all sort of answers. So that's one aspect which I feel is where the banks are going to kind of move towards. In addition to that, what has changed over a period of time? So historically, if you see for large organizations, when we always talk about banks, there are now fintechs coming in. There are smaller NBFCs and all sort of organization, small finance banks. So what's happening is that if they do not have the right infrastructure, it's no longer a roadblock or it's no longer a showstopper. Because I am working with few fintechs where they are leveraging cloud completely. So they are collecting a good amount of data, which is being stored in not on their own capital expenditure, but OpEx basis. They can just, so it's no longer a showstopper. Again, cleaning that data, a lot of tools are out there. So whatever intelligence that human beings have produced in last 30 years is now being converted into easy to use tools. Where I think banks need to invest in is this creative people. So at the end of the day, like that's what the differentiator that I see. How are human beings going to add value? It's by being creative, by coming up with new questions, by answering it in a different way. And that's where the disruption will be created in the industry. And that's where the competitive advantage will be created as well.
The way you have put it, Roopam, is it naturally leads me to ask you this. Where is the fitment of this entire data management aspect? Does it fit rightly within the IT? Does it fit in a separate department called analytics department or a BI department, or does it sit under finance? Where does the data leveraging this data, which is the most efficient way to do it?
That's a very good question, actually. And what I can tell you, what has worked in the past. So banks or organizations that are doing it rightly, what are they doing it right? And what can we learn from them? So one thing is that it's not IT. That's like something that all the organizations have discovered because IT is a custodian of data. They are making sure that it's available when needed, but that's where their role stops. The organization that are trying to do it on the same under the same umbrella of CTO and trying to take data analytics and strategy forward, because data analytics is a more strategic thing rather than an operational. I think like one model which works really well is aligning your data science and data analytics or machine learning, whatever you call it, with the business strategy. Where like IT supports this strategy very well using their technical competency, but there has to be a layer which is beyond IT, which is purely, you can call it a center of excellence for data analytics, data science. Sometimes you outsource it. Everything is being worked upon, but it's no longer IT. That is the only part which data analytics require. It's much more than that.
So I want to go one level below with you, more specifically on how these scoring models work. Mm-hmm. So two parts to my question. Part one, what are the most popular technologies which are being used by the organizations today, mm-hmm. right? On the credit modeling side of it. Second part of course, this question is that transforming? Is it going in some new directions? And why I ask this is, the new directions, not so much only about technologies, but because there are new data points which are likely to come in, and therefore organizations may want to be ready for that future data flow which is bound to come, and they should be leveraging that.
So that's a phenomenal question. That's a very good question. For couple of reasons. One is the kind of excitement that I'm seeing in last few years in Indian banking, in global banking, is something because of these technologies and new pieces of information through data that is coming. To start with technology part, your first part of the question, what technology is driving, and I'm going to talk about technology purely in terms of data analysis, model building, that's what you're asking about, and model delivery. So historically, like if you see, when I started my career, like in those days, SaaS was the key platform which most organizations were using. And that has changed significantly. SaaS was very expensive. That made a huge dent in P&L for an organization. And people started thinking, if I'm investing so much money, should I invest it in a tool or software, or is it people who are more important? And I always believe people were the more important factor because they were bringing in creativity. This is just a calculator. And in terms of calculator, if you see, there are now tools that are open source that are used by organizations across. So if you can call it Google, from Amazon, from the leading organization to the ones that are just starting, are using these R and Python and those kind of tools, which is available to everybody. So that makes a huge difference in terms of overall democratization of analytics and data science. And whatever you're saving on tools, I think put it in people. Like get the people who can actually think innovatively, can bring the disruption. And so that's where one aspect that has changed significantly in my journey as a data scientist. Second part you asked is what kind of new information is coming and what these new tools have to offer to this new ideas. So I'll give you an example, and this is not something that is happening in leading economies, even in the say economies who are data short can leapfrog into the next level by trying a few innovative things. So we were doing this analysis in Bangladesh where we were trying to understand what drives a person to make a repayment on time or not. Now, this is not rocket science. We all agree that when you walk into a shop, you get a very good idea of, like, let's say you are giving loans to a shopkeeper. And when you walk into a shop, you get a good sense just by looking around what kind of business that person is running, whether it's a stable business or not. And if you just spend barely, like I would say, like few minutes, you'll get a good sense what's happening in there. But this entire sense that you are getting is a qualitative thing. Now, how to make this qualitative sense-based thing into something which is more quantitative? So what we did is we ran a small experiment where we trained people and they went into this shop and they like to multiple shops. Like, I mean, historically we have seen their repayment record, and you just go into that place, you just check it out. What's the overall decor? Where is it located? And they just gave a rating on the scale of, say, like it could be a 7-point rating, it could be a 10-point rating. So 10 being a very good place and 1 being not such as, so lower middle class, lower. That way you can create a whole table. And this is like you are converting your sense into a quantifiable number.
You're moving your judgment into a quant data, which can be the base for the further analytics. Wonderful.
Exactly.
Yeah.
Now I can use this information. So anybody who's got 10, like I could go and check like what kind of repayment they have done. Are they good in terms of managing their finance? And answer came out to be yes. So it was a very glaring thing staring at us when we did this analysis that yes, the whatever we feel and believe and like see is an important cue for us to take it to the credit scoring model. But it's a difficult thing because you train these, say, 50 surveyors who can go out and do that. You can't train your entire organization to do that. Now comes the whole aspect of artificial intelligence. So think of a camera. Think of this person who walks into a shop. He doesn't have to do anything. He just holds this camera. He's walking around. He's taking these pictures. It could be a video. It could be images at times. And then think of an artificial intelligence that is sitting in the background, which is taking this, converting these images into what and you and I would convert in terms of our senses into this scale of 10. And now you have got something which is I think a technology which is leapfrogged into. And this is not something like I'm talking about futuristic thing. We are all doing it right now. I mean, when you're using your Google, Alexa, and all those things, we are all doing it. Now the idea is to bring it to bank.
Very true. I think very significant point you make, Rupam. This is entirely a new model. Next level of how do we bring in our judgmental, expertise to evaluate customers by the touch and feel, as we say in lending, right? How do you bring that touch and feel into data and then statistically validate it? How it can predict the default rates.
Correct.
So I've discussed with you enough on the credit side of it. I want some perspective also on the monitoring and anti-money laundering, those kind of applications of data. What are the current practices which are happening? How is it evolving? How is that situation evolving?
So then it's a very again a good question. Like credit, usually we used to have static data, so something that you collect using app forms. So people will give their income, age, and all those things. These were static at that point. When you're talking about these operational models are classified into two categories. One is a marketing side of it, where you're trying to assess the overall potential of the customer, where you're trying to see the propensity, whether they are likely to buy and take another loan from you, how you can grow business with them. That's one question that banks ask. And the second question is your current running loans, how are they going to perform? So this is the collection, recovery, then there's a fraud side of it, fraud models, anti-money laundering. Now, all these models collectively can be classified into what we call as a behavioral model. Now, I'll tell you why behavioral models are different from the one that we described as a credit scoring model, which was static point of time models. Behavioral models are something that is changing every day. So you are getting this whole time related data. So number of transactions that I'm doing on my ATM, number of credit card swipes I'm doing. So this data is just building up every minute, every second. And that's where this whole behavioral aspect of things will come in. So looking at somebody's behavior, can I say this transaction is actually not their behavior, it's a fraudulent transaction on their credit card. Anti-money laundering, same thing can be applied, but this is like not a transaction that makes sense. Like there's some level of dubiousness in this transaction. Marketing, you can look at it like, okay, this is how the person is growing, this is the level of banking that they are doing, they need a new car immediately. Why are we waiting for, like, let the competitors going to take them away from us? So that these are the kind of decisions that you're making on a data which is coming every second, minute, and that's where you build these models. And when you think of behavioral models, initially we used to use statistical techniques, but what I'm seeing is that of late, like machine learning, something that we were talking about, neural networks, or gradient boosting model, gradient boosted trees, GBDTs. These are all very powerful ideas that are capable of using a lot of data. So where logistic regression, the traditional models used to struggle is that, like, when you grow the number of variables, they started becoming untenable, because there's a level of multicollinearity that you're adding to the system. There is a level of same information that is coming in various forms. What these machine learning models are capable of using regularization and various level of tuning is that they can handle this mammoth of data, a massive amount of data, and convert it into knowledge without struggling with the kind of ideas that we were struggling with earlier. And that's where I see, like, data is coming now, a huge amount of data. So behavioral model, if you see, like, banking transactions, you've got taxes, GST, you've got social media, you've got, like, mobile phone, like, is generating so much data. So data is being generated is all generated on this time scale. We're kind of forcefully putting it in a credit scoring landscape, because that was easy to handle many years ago. Those constraints are not there anymore. So what we could do is we can actually bring in all this tidbits of information that is coming from all over around us, and make our models much more stronger. So I think that's the whole excitement part which I was talking about, which I'm seeing in last 3-4 years, and it's an exciting time ahead. And that's where I think, like, COVID is only going to bring what was holding in future much closer to us. So I was reading this very interesting quote lately. What is driving your digital strategy?
Mm.
So people, like initially it used to be CFO, and that's why you were asking, like, I mean, who should hold, whether it's CFO, CTO. It's no longer those people. It's COVID, which is driving your digital strategy, and that's where, like, I think whatever was going to happen will be speeding up with this.
Mm. You were very right. You were very right there, right? So the way our own understanding as organizations of how we handle the data that we have, and I said the how to dig those oil wells. You have oil wells, you own them, but how to dig this? Who's the right person to get the
Correct.
crude out? That's changing.
Correct. If I could add just one more point to this same idea of behavioral model before we move to the next topic, where banks want to invest at this point is the whole collection and recovery model, because that's where the biggest gap is going to happen going forward. So there are going to be people are going to struggle with economy, people are going to struggle with their own income, and that will reflect in their repayment record. Right now, we don't have any information because there's a moratorium going on. But as soon as this thing is lifted, you'll see a whole Pandora's box being opened up. And banks, this is a best time for banks to kind of invest in making sure that whatever data needs to be collected in next 2 months, they are equipped to collect that data, whether it is on the collection side, whether it is making phone calls, call centers, whatever. There are multiple avenues that we work with. And all that data, if banks have, I think whichever bank will have this data will have the huge advantage over all their competitors.
There's one thing which triggered me while you were stressing on the behavioral, data evaluation techniques as well as usages, which is a lot of businesses because of COVID, and you rightly said COVID is the driver today, right? Because of COVID, many of the businesses are going to pivot their business models.
Correct.
And the smallest example could be my restaurant, which was a fine dine-in restaurant, suddenly starts becoming a home delivery model, right? And every business, there are companies which are becoming PP manufacturers. And these may be some small-term pivots, but there could be some impact even on the way the business models are. And I see some challenge even within the behavioral data evaluation space of what your assumption was of the kind of transaction this business was doing, the kind of transaction this business will now do, maybe slightly different or drastically different.
Correct. No, that's a very good point. Like, I mean, restaurants are being closed down. Like, I mean, delivery restaurants are doing well, and this is a trend that is going around the globe. Like the traditional business is like whatever was impending in future. Like, I mean, which something that we thought like maybe happen in next 5 years or 10 years is happening now. Some businesses have taken this as this catastrophe or whatever we call it, pandemic, as a opportunity, and actually started doing more business than what they were doing historically. So there are multiple such examples. People who are like creative, that's where disruption, creativity, and those ideas become much more important than just doing the traditional business. And banks are going to certainly see that in a big way, because banks is like the lifeblood, or like, I mean, through which the blood flows in economy. And if the whole economy is changing, banks cannot still keep doing the businesses the way they were.
Very exciting points that you have highlighted, Roopam, today. Banks have to be ready with their systems, with their ability to capture the new data, ability to evaluate this data and modify whatever models they are using so that they get the maximum leverage out of these changing times. But it is still evolving. All of us know we can only gaze the future. And none of us have an expertise in being an oracle, but we can only see the trends which are coming in. Our only hope is that these trends throw up opportunities more than the challenges that it creates.
That's correct. That's a very good point. Like in the end, like people who will make the right kind of changes. And that's what we are seeing. Like, I mean, as you were talking about all the other industries, banks have to learn from what is happening around. It's all going to be digital. There is no way to like even push that future a little bit far away, because we were trying to
It
do
has
that.
got
Now,
it
like,
has got expedited now. It has got
got
expedited.
expedited because of this pandemic.
So very interesting. Thank you, Roopam. And that's all the time that we have today. And I hope our audience will take cues from it and start preparing for what lies ahead.
Thank you so much, Amit, for inviting me, and I'm so excited to talking to Frank Banker and you. Like, you are doing a phenomenal job.
Thank you, Roopam. Thank you. Thank you so much.